Dinshaw Irani joins us now, CIO with the Helios India. Dinshaw, so nice to connect with you. We are talking, even though we've known each other for years, I think we are talking to each other on this platform maybe after a gap of almost 10, 11 years. How you been, my friend?
Yes, still very much.
Well, can't complain in this market. So how exactly are you maximizing in this market where, frankly, there are a lot of ways to make money. Metals are going higher, banks are going higher, IT is holding on, pharma comeback has been real. I mean, it's a problem of plenty, isn't it?
Nikhil, first of all, thank you for inviting me on your show after a very long time, actually. You're right about that. Very good morning to you, your team, and the viewers. So, Nikhil, the point is that market, I mean, it's been one way all along. After the budget, in fact, it's been up some 10-odd%, which is creating some kind of a sweat for us because we want our new customers also to make money. But having said that, look at the fundamentals that the market is throwing at you. I heard you before, just talking before. In fact, since yesterday, you've been saying that the perception trade of 14 was quite fluid because there was no fundamental supporting it. But this time around, it's been fundamentally supported. I mean, it's ironical that COVID hit at the time that it hit at the beginning of the decade, in fact, or last year. The fact is that the world was slowing down. India perceptibly was slowing down. The GDP was down to 4%, if I remember right, for the last calendar quarter of 19, which was a big slowdown from 6.5 that I reported. So what happened after the pandemic hit was that the slowdown, which would have lasted for a couple of years, a painful couple of years, got compressed into a quarter or two, and then the Q-on-Q growth started moving up. So this time around, it's earnings which is supporting this kind of a run. And frankly, I mean, we've been around for the last 25 years in the market. And what we've done is we've just followed three simple strategies, or rather one strategy, but three themes that gives us a long runway of growth. And those themes are basically invest in companies which compete with public sector companies. So basically private sector banks, infrastructure, healthcare, these are the three main sectors. Then the demographics that India has, unique demographics that India has. Basically, we're talking about under-penetrated consumer names, QSRs, and so on. And the last one is export-oriented companies, which is mainly your IT, ITES, and enable services, pharmaceuticals, chemicals, and so on. So these are the three main themes that we keep playing, and probably it'll last us out for another 25 years, given what the market is doing now.
But is there a lot to be made in the first theme? Invest in public sector invest in companies which are competing for market share from PSUs. Because most of the PSU companies, with the exception of an IRTC or container corporation, they've lost their market share, they've lost their mojo. So do you think what was a great trade, let's say 10 years ago, 12 years ago, when you bought into HDFC Bank, Axis Bank, because the PSU banks were losing market share, is that trade over now?
So, Nikunj, despite, private sector banks, since you're talking about, despite the privatization happening in the early 90s, still the private sector banks combined together control only a third of the balance sheet of the banking sector per se. 2/3 is still lying with the public sector banks. And let's look at what the finance minister had stated. That we're looking at a 5 trillion economy 5 years down the line, which is not going to happen. But let's assume it's even 4 trillion economy. We're still talking about a 50% growth in nominal terms in GDP per se over the 5 years. And if you look at that, then you're talking about, now I said 2/3 of the balance sheet is controlled by public sector banks, but we are quite aware that quite a few of those do not have growth capital going forward. So we're basically talking about a third of the public sector banks and 1/3 of the controlled balance sheet of the private sector banks controlling this growth going forward. So we're talking about probably a 17-18% growth on a compounded basis for private. So there's still a lot of steam left in private sector banks going forward per se. So that's our two bits. And that's why we believe that for next 25 years, probably this themes will play out for us in total.
Is one better off buying SBI at a price to book of 2 times or Kotak Mahindra Bank at a price to book of 6 times? Ultimately, investor
Okay.
wants value for the money.
No, true. So as I said that we also have, I didn't say that, but let me tell you, we also have another segment which gives us a leeway of investing in, some stories which we believe are a longer term story. And SBI is going to be one of them. And though we do not talk specific, but the fact is that we have SBI in our portfolio also. And that's mainly because it's adjusted book. I mean, you talked about 2 times gross, but if you adjust it for the subsidiaries, it's even less than 1. So that way, it's a good stock to be in. And to clarify, we also have it in our portfolio for our investors. It's in fact in the top 5 holdings for our investors per se. So I agree with you. Yes.
Okay. You know, the huge push on infrastructure, that's also something that's now come right to the forefront. And then on the back of that, again, the cyclical theme playing out. Do you see that as well as being one of the major themes that the market now focuses on moving forward?
So, sorry, I mean, cyclical, we always avoid cyclical per se, because most of the cyclicals are commodities, and commodities, it's too hard to predict the price movements globally per se. I mean, seldom you come across any house which has done the right play on commodities per se. So that is one that we avoid. In infrastructure, again, we do not get into companies which deal directly with governments per se, state or center. So center is still preferred against what the state plays are, because I mean, governments change, payments get delayed, contracts get rescinded. So it's easier to avoid those. And in fact, we've always been saying all along that if we feel that we're getting left out of a rally in infra, probably there's only one stock which is there in all of infra per se, and that's L&T, and that's one of our holdings in our portfolio. And we continue to hold that. I mean, we got into that stock and we continue to hold that stock per se as such. And frankly, I mean, if infra is picking up, you're talking about a lot of ancillaries which will come into play because of infra. In fact, there was a study done by RBI that if center spends 1 rupee on infra, I mean the center spends, then the impact on the GDP is 3x of that. So it's obvious that 3x will trickle down to consumer names and whatever you such, banking sector, because the credit growth has to come in as such. So there's a lot of ancillaries which will play out. Infra is probably at the top of the pyramid to trickle down to the rest per se. So that's how we're playing that particular sector.
Interesting, and that's an important point as well on the ancillaries to note for some of our viewers. But Mr. Irani, I want to understand from you, when you're looking at the rising names and the bottom-up approach in a market like this where everything now seems to be an opportunity, where do you dig deep? Where do you look for that right combination of opportunity, reasonable valuations, as well as potential to grow?
So right now, I mean, what we're trying to do is avoid the froth rather than look for reasonable valuation. Frankly, I mean, even if you talk about valuations, let's look at what the market is quoting at per se. It's like probably at close to 1 time GDP, which at the peak was 1.8x. And on the PE basis, it's at 22x forward earnings. But again, PE standalone looks expensive, but you have to, finally relate it to the interest rates, because I mean, GSEC yield at that point in time when it was 22 at last was probably at 9% plus, and today they're close to 6. So that kind of a correction you've already seen in GSEC rates, and ultimately PEs are 1 divided by GSEC. That's your thumb rule as such. So if you do that, then probably the markets are more or less controlled valuation. But what we avoid today is the froth which is there in the market, and you can see a lot of that in a few consumer names per se. I mean, be it the paint segment or be it MNC consumers segment. So that all is what we are trying to avoid. Even in autos, we believe the run has been overdone, and we're looking at avoiding that particular run, and passenger vehicles, specifically in autos and two-wheelers per se.
Okay. That's an interesting one that you got, an avoid in autos. But I was just looking at the classification of your India PMS Dinshaw, and the major chunk is invested into large caps. And please correct me if I'm wrong here. I understand that 78.8% is allocation is towards large caps. Why so? I mean, do you not believe that there is a higher chance of small and mid caps which have been underperforming relative to large caps would have a better chance of a higher gain from here onwards?
So, since you pointed that out, so around 78% is in large caps, around 20% is in mid caps, and around 2.5% is in a small cap company, one single small cap company per se. But the fact is that we are, frankly, the kind of sectors we look at, private sector banks, or for that matter, IT and chemical, they're all mainly in the large cap category rather than the small cap category. So it's more of a call on the sector that we've taken. And IT, there are mid caps, but we avoid IT because mid caps in IT or small caps in IT because the run today is of large deals, right? You're talking about lift, shift, transform kind of deals which happen there. You need a large cap to take care of that. So I don't think, unless the small cap is a niche player or the mid cap is a niche player, will you be able to participate in this? So it's more of a sector classification rather than our call on the market caps per se. But frankly, if there is an opportunity, we do not think twice before getting in on the sector, the market cap classification.
Sure. I just want to probe a little bit more about, the point that you were making on autos. Why is it that you don't have conviction in the story? Because, we were chatting with Pavan Goenka yesterday. Seems that the rural recovery is here to stay, and they were very bullish and upbeat on the tractor revival and the sales continuing forward. I was just looking at the China Jan retail passenger vehicle sales data as well, which is up a solid 25.6% year on year. I know you can't talk stocks, but I can, so that only makes case for Tata Motors, for instance, or other, ancillaries like a Motherson Sumi only stronger. Why is it that you don't believe that this is a lucrative story?
So I'll tell you the more of a macro picture. By the way, we are into the rural auto space. Tractors you mentioned, we are exposed to that particular, and we have also been exposed to CVs. So it's not that autos totally in toto is a problem. As I said, PVs is a problem per se. And the reason for that is that there's this big elephant in the room today, which is called EVs, right? And frankly, I don't think Elon Musk became the richest man in the world just by chance. I think the world anointed him as the next disruptor. You look at the earlier disruptors who came in, Jeff Bezos or Bill Gates. These are all disruptors they're trying to, and frankly, our belief is that within this middle of this decade or slightly later, EVs will start selling more than ICs. Yeah, that's a big call to take, but then inflections are happening this way. If you read the book, Future is Faster Than You Think, you will realize that it's a hockey stick in their case also. When the inflection point is reached, it's just a crossover that happens. Yeah, so we believe that. And frankly, when you mentioned about, you did say Tata Motors and China, if you see the market shares of JLR in China, they're moving down. They're not moving up. And also this is despite, if you look at the peer group, yeah, if you compare it with the peer group. And also the fact is that the discounting has moved up for JLR in China per se. So it's not a one-side story. Maybe the volumes are picking up, but it's coming at a cost.
I just want to bring out the Tata Motor DVR. Nobody talks about it. I'm not going to ask Dinshaw a question on Tata Motor DVR. I'm just bringing it out for the benefit of our viewers. The discount there is very large. Now, the bulls would say that, look, this discount is not going to last if Tata Motors, they start to pay dividend. So if Tata Motors starts to pay fat dividend, the discount there is not going to be all that large. Remember, DVR is an instrument where you don't get voting rights. But for an individual investor, do you really care about voting rights? Markets always give you a advantage to buy into some of these DVR stocks. Not too many DVR stocks are there in India. There was one for Jain Irrigation which did not do very well because the company had issues. But yeah, Tata Motor DVR, it's going to come up on your screen. Yeah, I mean, if Tata Motor is a turnaround story, this discount is not going to last for a long, long time. Look at the discount. I mean, the discount is at an historic high, so to speak. Dinshaw, you mentioned that I want to bet on demographics. The easiest way to bet on demographics is you buy consumer staples. They're expensive. Autos, we've heard your view. Banks, again, a bet on demographics, which you already own. What else? What is the other way to bet on Indian demographics?
So, sorry, I mean, we do not, consumer staples is one thing that we are not that gung-ho on, because as I said, that valuations are off the back there, per se. And frankly, most of these consumer FMCG stocks are not the actual demographics stock which will be appealing, but they're so large that this base will get lost. So what we look at is niche players within that. I mean, I've got 2 millennials in the house, and it's a tough time controlling them to spend. I wonder what happens when they get into this earning class in this particular decade. I mean, the way they'll run through the salaries is going to be phenomenal. So basically what you're talking about is mainly QSRs. You're talking about consumer-facing finance companies, be it credit card companies or housing loan companies for that matter. You're talking about under-penetrated consumer names, basically durable names that we look at. So those are the ones that you can look at. So these are the niche players that you want to play out in this particular move on demographics. As you rightly said, there are quite a few others which can come into play, but I think these are the basic ones.
Yeah, for the longest time I've interacted with Samir, and what I understand about your fund philosophy is that the folks at Helios, they like to buy something which is new and something which in a sense could be the next big trend, whether it was buying HDFC Bank years ago, buying into Delta Corp, buying into brokerage stocks. What is that next theme which you think could be an outsized theme for this decade? I mean, like they say, catch them young and see them grow.
Well, we have a few in our portfolio which have done fairly phenomenally well. I think one of the themes that one can look at is the way PLI is going to affect, I won't name the players, but the PLI scheme, how that will affect them in the next, say, 4 or 5 years. That's one theme that can be played out. Then there are others which are platform providers where we believe that digital, I mean, in fact, this decade is going to be known for new technologies. Yeah. So you have to be in those segments which offer these kind of new technologies or platform players and so on and so forth. So these are the few, unfortunately, India doesn't have many, but there are a handful that you can look at and probably, play those out, because this decade is going to be this kind of a curve for these kind of new players who come in as such. So.
After a 40% rise for the IT index and a 50 to 60% jump in a stock like Infosys and a 50-60% jump in HCL Tech, is large cap tech fairly priced or richly priced?
Okay, I would call it fairly priced, and I'll give you the reason why. Because, I mean, you've been around, Nikhil, for a while, and you must have remembered when these guys were giving a double-digit top-line growth and consistency in earnings growth. They were at 30 times forward Ps. In fact, much higher, but more reasonable was 30 times forward Ps. So from here on, I believe they're reasonably priced. And from here on, it'll be mainly earnings growth which we're tracking. And frankly, I mean, look at the kind of the growth in market that they're looking at. As I said, that the new technology adoption, which was earlier haggled upon because of legacy issues and because of security issues, now everybody's running towards cloud migration, towards digital transformation, because it's a matter of survival. And all these trends, which would have happened over a 10-year period, are now compressed into a year or two. And obviously, these are the players who are benefiting the most. So I believe that the double-digit top line is going forward. In fact, some of the IT players are giving that kind of a guidance if you talk to them off the record. So this is what is going to happen going forward. So I think it's fairly reasonably priced. And I would believe that earnings growth will be the ones which will be getting them forward. Maybe another re-rating if it may happen. So that is if the margins pick up. Which
Dinshaw,
there is
so
a
nice
lot
to
of
connect with you, but the challenge with,
sorry.
No, Dinshaw, I'm saying it's so nice to connect with you, but the problem with meeting old friends is that they keep on reminding you that we've known each other for 20 years, 15 years, and that's a polite reminder that at least I'm getting old.
Same here. Yeah.
What are you telling your clients, Dinshaw? Because you're now managing money in India. You've not had money in India. It's the first PMS which you've launched in India. What are the general return expectations? Because in India, the first thing they ask you, like the Maruti ad, kitna average milega, kitna return expectations hona chahiye?
So that frankly, I mean, as I said, again, let me remind you about our age, that we've been around in the market for a long time, and we know that the markets behavior is not. So it's a longer term. If the client is along with us for the longer term, we say that nominal GDP plus 3-4% is what you can look at from the market on an average going forward, per se. And which is actually true, because if you're talking about a nominal GDP growth of, say, X, 3-4% is normally what the earnings kick in as such. And we hope to outperform that as such going forward. So that's how I think we should play it out in the market, let's say, also.
Okay, Dinshaw, great to have you on the show, and we really hope that you can make it more often. It would be good to have you on the show.
Thank you.